Fuck me. Once this thing gets going in the wrong direction, this is fucking huge.
Hey guys, welcome back. So today we'll be looking at the different ways you can make money within blockchain and what are some options that may suit you best. So let's say you decided, hey, blockchain seems to be pretty interesting and I want to make some money. This video is for those people who want to know what are the different options available to them. I will go through this decision tree and I will also go through some of the different options in terms of their risk and rewards. Okay, so first thing you want to figure out is how much money can you risk? Is it a lot of money, which is about, let's say, more than $250,000? Or is it a decent amount of money, which is, let's say, about $100,000? Or is it not much money, which is about, let's say, less than $10,000? Now, the amount of money you can risk changes the options that you can take. So one example would be if you had a lot of money, more than $250,000, then maybe earning interest on stablecoins would be worth looking at. But if you didn't have a lot of money, let's say less than $10,000, then stablecoins wouldn't be something worth you looking at. Okay, so hopefully that makes sense. And by the way, the scale that I've based this on, so the scale of a lot, which is more than 250,000, decent, which is around 100,000, and not much, which is about 10,000, I've based that on the minimum amounts you need to invest in a hedge fund, which is somewhere around 100,000 to 250,000. So this scale is based off that minimum amount. Okay, so now I will take a few different paths through this decision tree to show you how to use it. So let's start off by asking ourselves, how much money can you risk? And for this example, I'll say I don't want to risk more than $10,000. So that would mean not much. The next question you have to ask yourself is, how much time can you commit? Now, the amount of time you can commit also changes the options you can take, because certain options requires a little bit more time, a little bit more effort, a little bit more stress tolerance compared to other options. So an example would be, let's say if you didn't have that much time, you wouldn't be able to do trading, for example, because trading is pretty much like a full-time job. So moving on with the example, we said we didn't want to risk more than 10,000. And now we say we can't actually spend that much time on it. So because you can't spend that much time on it, I would suggest you do passive investing. So passive investing is when you're spending a minimal amount of time researching the different investing options you have. Now, because you're spending a minimal amount of time, it may not be worth you looking at other options which are more risky, which require a little bit more time commitment because they are risky. So passive investing is looking at things like blockchain ETFs and blockchain equity. Now, because you don't have the time, investing in a blockchain exchange traded fund, an ETF, would help you minimize the risk, because an ETF helps you diversify your investment for you. Also, equity minimizes risk if you invest in large cap blockchain equity companies, for example, like Coinbase. Now I'll continue this example, but I'll take a different path and I'll say I can actually commit a lot of time to this. Then I suggest you do active investing. Now, active investing is pretty much like passive investing, but you have the time to research in more granular detail individual coins, stocks, strategies, and companies. Now, this means you're taking in more risk, but because you have that time, you're able to minimize or mitigate that risk through your own hard work and due diligence. Now, some examples of different options you have is HODLing, which is holding on for dear life, which is basically what I would say most of the crypto community does, which is researching a coin, believing in it, and then buying it for the long term because you think the price is going to go up. You can also have a look at NFTs, which is kind of the same thing as HODLing, but you're doing that with NFTs. Let's say you found an NFT and you think the community is growing, you think it's going to grow up in price. So you buy the NFT and sell it for a higher price at a later date. You can also look at staking, which is simply owning an amount of a certain coin. And if that coin is able to be staked or has a proof of stake mechanism, you're able to stake that coin for yield, which is basically the same as saying you're locking up that coin, and because you lock it up, you get a yield on it. Now, if you want a better idea on staking, just let me know in the comments below and I will make a video on it. Now I'll continue through the decision tree, but I'll take a different path. So let's say you start out again and you say, yeah, I have a decent amount of money, around $100,000 I want to invest. And then you ask yourself, how much time can you commit? But here you say, oh, okay, I don't actually have that much time. So here I would suggest passive investing again. Why? Well, because you don't have the time. You don't have the time to research all the different risks in a granular detail. You don't have the time to do due diligence into individual coins, NFTs, looking at different staking options. So because you don't have the time, it's probably not worth you looking at that. You're probably better off just looking at some ETFs, which help you diversify your risk, or looking at some large cap blockchain equity. Now I'll continue down this path, but I'll take a different route and I'll say, I have a decent amount of money and I have a lot of time. The next thing you want to ask yourself is, are you patient or are you impatient? So what I'm really asking here is, how soon do you want the return on your money? If you're looking for a return on your money within 12 months, then I would probably say you're impatient. If you're looking for a return and you don't really mind when the return comes in, let's say 1 year outwards, then I would say you're patient. But let's take the impatient path as an example. So let's say you want the money within 12 months. I'm impatient. Then I would suggest you look at swing trading. So swing trading is doing some technical analysis, maybe doing a bit of fundamental analysis on an individual coin, signing up to a platform which lets you trade, and then buying a position from anywhere between a few weeks to a few months. And then when you're seeing a good exit out of that position, which probably means that the price that you bought the asset at is now at a price where if you sell it, you would be making a gain or a profit, then you would be selling out of that and making a profit. So that is swing trading. Now with trading, it's pretty much like a full-time job. So you have to be really honest with yourself. Do you actually have the time to commit to that? And with trading, you have two options. There's trading on decentralized exchanges, or there's trading on centralized exchanges. And I'll get to the differences of that in a minute. But in general, with trading, if you get it right, you can make a lot of money. Now going back, I'll take another path. I'll say, this time I am patient. I can wait more than 12 months. Then I would suggest you look at active investing again. Now the active investing up here is different to the active investing down here, because you have now a decent amount of money. And because you have more money, you have a couple more different options you can take. Now, the active investing up here, you have the same options as the active investing down here. You have the same HODLing, you have the same NFTs, you have the same staking. But now, because you have more money, you have equity. Now, the equity here is doing some due diligence on lower cap blockchain stocks. So the equity here is also different to the equity down here. The equity down here is investing in large cap blockchain stocks, which are in a way less risky because they're larger companies, but the returns are lower. But the equity here is investing in smaller cap, so smaller companies, where they're not as established, they're more risky, but the returns may be higher if you get it right. You also have the option of running a node. So running a node is kind of like saying running your own mining rig or running your own validator node, which is basically running some hardware like a server and providing the underlying security of a blockchain network. And for you to do that, you get a reward to do that, or you get rewards for doing that. You also have venture capital, which is saying you are an angel investor and you are going out and meeting startup founders, understanding what they're doing, and then investing into their company. It's very risky, but if you get it right, then you win big. You also have ICOs, which is initial coin offerings, which is the same like initial public offering. This is also the same as being an angel investor, but with ICOs, they are even more risky. And then you also have yield farming, which is a term from decentralized finance, where you are essentially giving your money to a decentralized exchange, helping them create the market by giving your money. And by giving your money to help create the market, you get a yield or you get a return on that. So to summarize, because you have more money, you have now these different options. Whereas before, down here, if you don't have a lot of money, it's probably not worth you getting into yield farming, because the yield that you're going to get on that small amount of money is going to be so small, it's probably not even worth you doing it. It's probably not even worth you taking on that risk. Okay, so let's go through another path. Let's say, okay, how much money can you risk? And I'll say, yeah, a lot of money, more than $250,000. How much time can you commit? I'll say, not that much time. If that's the case, then I suggest you do passive investing. But the passive investing up here is different to the passive investing down here, because now you have more money. So exchange traded funds and equity is the same, but now because you have more money, you have earning interest on stable coins, you have managed funds, which is giving your money to a hedge fund, and there's also venture capital funds, which is giving your money to a venture capital fund. So because you have more money, it's probably worth you looking at these things now as opposed to when you didn't have that much money. Because, for example, with interest on stablecoins, if you were to try to earn some interest on less than $10,000, it wouldn't be really that, the yield on that wouldn't be really that much. Whereas if you had $250,000, the yield on earning interest through stablecoins means it is probably a smart move to do stablecoins. Also, managed funds, giving your money to hedge funds, there's a minimum amount of about $100,000 to $250,000. So, if you have less than 10,000, you definitely can't do that. And the same with VC funds as well. There's a minimum amount. So if you had 10,000, you probably couldn't do that. Okay, so now let's continue with the example, but let's take a step back and let's say, you have $250,000. How much time can you commit? I have a lot of time I can commit to this. Now, again, you ask yourself, are you patient? Or are you impatient? If you're impatient, that means you want the money within 12 months. Then I would suggest you have a look at scalp/day trading. So scalp trading is when you are trading and you see a very marginal percent gain on the token or the position you're holding, and you trade out of that and lock in that gain. Now, because you have so much money, even that marginal gain is going to make sense for you. So an example would be, let's say you had a trade with $20,000 and you went in at 20,000 and you saw a 1% gain. And then you figured, okay, if I trade out of this now, I would lock in $200 profit. But let's say if you had only $10,000 you can risk, let's say maybe you put $1,000 into scalp trading. Now with that $1,000, you saw the same gain of 1%, but that 1% is only $10. So do you understand what I'm saying? So because you have more money, you're able to have these different options now. Whereas when you don't have as much money, then some of these things are probably not worth taking that risk. Now, day trading is the same as scalp trading, but you're trading on the daily gain, or you're trading day by day and locking in those gains day by day, instead of scalping, which is literally the next move, you're taking a gain off that next move. Now, if you want to learn more about scalp or day trading, put it in the comments below and I'll make a video on it. Now, the options here is you have yield farming. And I say yield farming because you have a lot of money. You can give your money to a decentralized exchange. And because it's a lot of money, the yield you're getting makes it worth taking that risk of giving your money. And then you also have trading on centralized exchanges, where you're able to take leverage. So trading with leverage means you're trading with someone else's money. And when you win on a trade, you win big. But when you lose on a trade, you lose big. But because you have more money, you're able to take more risk, which is why I suggest this here as opposed to down here when you don't have as much money with swing trading down here. So because you have more money and time, you're able to take more risk. Okay, so now let's move back one step. We have a lot of money. We have a lot of time. We can wait more than 12 months, so we're patient. I would suggest you look at active investing. Okay, so hopefully that makes sense. Now, one thing I want to comment on is some of these things straddle between passive and active. So for example, something like staking could be considered passive, because with staking, once you're done with the initial setup and you're happy with the token that you're staking, it's pretty much passive after that. But it all depends on your own subjective feel about how much time or how much effort you could put into doing that initial due diligence. Another example would be HODLing as well. So HODLing, once you've done that initial due diligence and you want to hold on to, I don't know, Chainlink for 5 years, then pretty much after that is pretty much passive after that. But, it all depends on, your own feel of how much time it would take for you to do that, and whether you do the necessary due diligence to make a good call on that. And how do you know you've made a good call? Well, that's basically what this whole channel is about, basically. So I'm trying to find what is the framework, what is a standard way to value tokens. There isn't one at the moment, so that's what this whole channel is about. Anyway, I hope that is useful and breaks it down for you. I will now move over to the right side of this infographic here, which is going down the list of options from the least risk of total capital loss all the way down to the highest risk of total capital loss. So the risk of total capital loss means losing all your money. And basically what this graphic is saying here is we start off with stablecoins, then it gets to ETFs, hedge funds, equity, HODLing, staking, nodes, VC funds, VC, NFTs, ICOs, trading on DeFi, yield farming, and then trading on CeFi. Now I'll go through each of these in more detail to explain to you why I've put it in this order. Also, if you noticed, these options have colors, or it has green, it has one color, it has the green color on it. And a light green means it's low potential of a return, and dark green means it's high potential returns. So high potential returns is the returns you're getting is going to be high. Low potential returns means the return you're getting is going to be pretty low. Okay? So it doesn't mean that the potential is high for your return. I'm saying that the return is high. And basically here I'm not saying that the potential to return is low. I'm saying the return is low. Okay? So if we go through it here, stablecoins is a low return, but it's steady. Gets a bit higher with ETFs, managed funds, equity, but it's still on the low scale. Then it gets into HODLing, which it gets a bit higher, staking, Nodes, it gets a bit higher again. VC funds, same. VC gets higher. NFTs, it goes a bit lower. ICOs, it goes higher. DeFi, it goes lower. Yield farming is about the same. Trading on CeFi has very high returns. So I'll go through each one, starting at the top here, which is earning interest on stablecoins, which has the least risk of total capital loss. You can lend stablecoins on both centralized and decentralized platforms. So an example of a centralized platform is Nexo. So you see here, you can deposit stablecoins and earn an interest on them. Now, the risk with stablecoins interest is if you're on a centralized exchange, the risk is that you have to trust this platform to run their operation in a regulated and safe way. For example, we saw the kind of the downfall of Celsius, which was a centralized borrow and lender, and it ended up going under because they weren't doing things how they should be done. So that is the risk with a centralized borrow and lender. Now, if we go to a decentralized borrow and lender, like for example, Aave here, now the risk is not that you have to trust Aave, because in a decentralized market, you are responsible for your own tokens. So all these tokens here, they sit within your wallet and you are responsible for making sure they're safe. So the risk here is the protocol risk. So for example, this platform might get hacked, or there might be some bug in the code or some technical related issue that happens. That would be the risk here. And basically, this is all managed through on-chain. It's all managed through smart contracts. So if you're wondering, how am I able to collect my money? How is there able to be an interest rate? How is my money safe? It is all managed by code, basically. And I think all decentralized platforms need the borrower to deposit an amount of collateral more than the amount that they would be taking out as a loan. So it is over collateralized. So that gives you a margin of safety. Now, the potential returns with stablecoins is not that high because they are just stablecoins. So stablecoins is a cryptocurrency which is pegged to the value of a fiat currency, for example, the US dollar. Now, because it's just a US dollar, it has no ability to appreciate in the same way like Bitcoin does, because it's simply the same as a US dollar. Now, moving on to ETFs. An example of an ETF would be the Grayscale products here. So for example, the Grayscale Bitcoin Trust. This allows you to essentially own Bitcoin without actually buying Bitcoin itself. So Grayscale buys the Bitcoin for you, and you invest in this Grayscale product where you're able to potentially gain on the appreciation of the underlying Bitcoin that Grayscale owns. So this is just one example, there are more. And the risks with this is that you have to trust that Grayscale is actually managing or actually owns this Bitcoin. Now, moving on, we will go to managed funds here, which is giving your money to someone to invest for you, like a hedge fund. So an example of a managed fund is the Pantera Capital fund here. Pantera Capital is a hedge fund which provides exposure to the blockchain space. We have a number of different funds here. And it's kind of the same concept as an ETF. where you're giving money to someone else to manage and purchase or to give you exposure in the blockchain space. So taking a look deeper here at this liquid token fund, multi-strategy vehicle that typically invests in 10 to 20 liquid tokens at any point in time. Discretionary strategy focused on decentralized finance and adjacent assets. Minimum investment, $100,000. Again, the risk here is that you have to trust that they do a good job or they're handling all these assets in a regulated and safe way. Now, moving on, we will go to blockchain equity. So examples of equity would be NVIDIA, which is providing all the GPUs for cryptocurrency mining and validating. Block here, which is payment processing ecosystem. It's now I believe it integrated some cryptocurrency capabilities into their platform. IBM is really big into blockchain. Of course, Coinbase, world's largest cryptocurrency exchange. So this is what I mean by equity. Now, the risk here is if you are investing in equity, you have to do all that research yourself. If you're investing in large cap like these, maybe it's probably less risky than if you were looking at smaller cap stocks on the NASDAQ. With those smaller cap stocks, you would probably need to do some research behind it. So the risk is on you with this. Now, moving on, we'll move on to HODLing. Now, holding on for dear life is pretty much what I believe all of you do. And that is buying the underlying digital asset like Bitcoin, Ethereum, or XRP. So examples of that, I probably don't need to go through this, but yeah, these are examples of coins, tokens, projects, whatever you want to call it, that you want to HODL, which is hold on for dear life, which is, it's a long-term investment. You believe in that project and you're buying it for the long term. Now, the risks with this is, of course, it's on you to create a wallet which you believe you can keep your assets safe. And also the risk is you're picking which coins you kind of like the investment prospects of. And the risk is on you to do that. You have to do the research. Okay, so moving on, now we will move on to staking. So examples of staking is you can stake Ethereum, you can stake Solana, you can stake Cardano, you can stake Avalanche. So staking is simply having an amount of Ethereum, for example, and staking that, which means by staking Ethereum, you are securing the Ethereum network. And because you are securing it, you earn a yield on it. Now, staking is different for different projects. So you have to look at what staking entails for each project. So for example, staking with Ethereum, you actually need to have 32 Ethereum, I believe, to stake. But there's also liquid Ethereum, which you can take your Ethereum, convert that into liquid Ethereum and stake that, which you don't need 32 Ethereum for. So there's different requirements, essentially. There's also, you can delegate your Ethereum to an Ethereum validator. So that means if you don't have 32 Ethereum, you can just simply delegate whatever Ethereum you have to someone who's already staking Ethereum. So then you get a reward on that and they get a reward, but they also charge you a fee for providing that service. You can earn it. There's a lot of different ranges of yields here. You see, Polkadot is 14%. But if you have a look at it deeper, you also have to be aware of the inflation. So every project has their own inflation rate, or it may not have. But it seems like here, Polkadot has an inflation rate, and the real reward rate is actually 6%. not 14%. So this is an inflation adjusted reward here. Now the risks with staking is like the same as hodling. So you have to make sure you keep your assets safe in a safe wallet. Or if you're delegating your stake, you have to check out the validator that you're delegating to. You have to check out whether they're doing a good job or not. Okay, so moving on. Now we will go to nodes. So nodes, again, just to recap, nodes is kind of like running your own mining rig, which means having the hardware, setting up a server, having internet connection, and then installing the software for the network, running the client, and then validating transactions on the network. So you become a node on the network. And because you're validating those transactions, you get a reward for doing that. So for example, if you are a Bitcoin miner, you are validating the Bitcoin transactions, and the reward for doing that is Bitcoin. So if we look at, for example, Solana, you can actually run your own Solana node if you wanted to. So what does that mean? What do we need to run a validator node? So you obviously need to have the hardware. There's hardware recommendations here. I won't go too deeply into Solana, but I'm sure, each project has their own requirements essentially. And for running this hardware, you are getting rewards for doing that. What you're doing is basically securing Solana, the network. You're securing the Solana network, and you can earn rewards for doing that. And by running your own validator node, you can offer your services to people who can't. So for example, a delegator is someone who can't run their own node, and they give their money to you, who is a validator. And basically, you take a cut of their rewards for providing them that service. So the risks with running your own node is obviously you have to know what you're doing. To run your own node, you need to set all that up. You need to buy the hardware if you need it, if you need to set up the software. There's a lot of different things you have to be aware of. So moving on to VC funds. So VC funds is kind of like a hedge fund, but the fund that you're investing in, they primarily invest in new companies and startups. So the VC firm will have a portfolio for you to invest in, and you give them your money, and they will invest that money in how they see fit. So some examples of that is Framework Ventures here. This is the portfolio they have: Optimism, Aave, bunch of different companies here. These are all, I'm assuming, blockchain companies. And basically, you're giving your money to this venture capital firm to find the next Ethereum, basically. And you can, obviously the returns are high if they get it right, but they also get it wrong a lot of times. I think it was something like, 2 out of 100 succeed or something like that. So the risk here is that you may give your money to them and they may actually not return anything for quite a while. I don't know how many years it would take, but for quite a while. But, the reward is big if they get it right. And that pays for all the years of not getting it right. So that's the risk there. Now moving on to VC or venture capital. So this is where you are acting like an investor, looking for startups yourself, doing the due diligence yourself, meeting with founders yourself, and giving them your investment. So if you're an angel investor, obviously the risk is having to do all that research yourself, meeting with the entrepreneurs, understanding what they're trying to do, their vision, getting a sense of who they are, what they're trying to build, whether they can actually do it or not. And then, working out some deal with them and investing in their company. So that the risk there is that you have to do all of that. Obviously, you need a lot of time to do it. But, if you get it right, then there's a lot of gains you can make as well. So moving on to NFTs. So NFTs is obviously basically investing in NFTs, trading, buying, selling NFTs. This is a whole world in its own. If I'm being honest, I don't know too much about what's going on here. But, the risk here is understanding what NFTs are gonna pop in price. There's so many NFTs being created every second. How do you tell which ones are going to even be on the top 1,000 of this list? So it's a lot of working through the weeds, joining Discord groups, understanding what's happening in the community, interacting on Twitter, just understanding what's going on, participating a lot. You need a lot of time to figure out. If you get it right, then obviously there's a lot you can gain. But I just think with NFTs, there's just so much that can go wrong. And how the hell do you even value something like, I don't know, how do you value something like this? It's a lot to do with the community, basically. So you need to be within the community, and you need a lot of time for that. So that's the risk with that. So moving on, we'll go to initial coin offerings, or ICOs. So this is when a new crypto network or coin or project or token, whatever you want to call it, is launched or is about to launch, and you take part in their ICO, where they give you a very good rate for buying their token. And then the idea is that when the launch takes place, the price appreciation in that token will explode. And because you got in early at such a good rate, you stand to make a lot of money on it. So this is kind of the same concept as being an angel investor in venture capital. It's also kind of the same concept as NFTs. It's also kind of the same concept to HODLing. But they're very risky because, unlike venture capital, where you're able to meet the entrepreneur, and unlike NFTs, where you're able to participate in the community and see what's going on, and unlike HODLing, where they're already an established coin, there's a lot of content that's out there, there's a whole community behind it. With ICOs, there's going to be a very small community, and you may not get to speak to anybody in the project. So the risk here is very high, but if you get it right, then the rewards are very high. There's so many coins that are popping up every single day, and the risk is that you just have to do your best to understand what they're trying to do and whether it's real or not. Because a lot of them, they've turned out to be rug pulls, which is taking investors' money and then just disappearing, essentially. But if you get it right, let's say you invested in Ethereum ICO, you would have made a lot of money. So that's that. Almost done. So now moving on to trading on decentralized exchanges. DeFi here means decentralized finance, by the way. So trading on DeFi would be on platforms like DYDX here. I believe they have the largest market share of decentralized exchanges. It's just a trading exchange, basically. The risk here is obviously keeping, because you're not on a decentralized exchange, you are in custody of your own money. So it's up to you to secure your own wallet, your own funds. It's up to you. if something goes wrong, there's no one you can call. And also, obviously, the risk with trading is that you can, you could probably lose all your money trading as well. So that's the risk with decentralized exchanges. But if you get it right, if you know how to do technical analysis, you know how to do a bit of fundamental analysis, you know how to see patterns, you understand, you spot like a channel that has been forming. You understand how to get in, you understand how to get out, you know what works at certain times, and then it doesn't work anymore, then you find a new thing, speak to other traders. It's like a full-time job, essentially, trading. And if you don't have the time to dedicate, then it's probably not worth you doing this. Okay, so moving on. Now move on to yield farming, which we see here a picture of a unicorn and some money floating in water. But it will make sense in a minute. So one example is Uniswap here. They're also a decentralized exchange, but you can give your liquidity, and I'll explain what that means, to create the market for Uniswap. So giving liquidity means that you basically create the market and you get a fee for creating that market. So in this case, you have some USDC, you have some Ethereum, you deposit both of these into Uniswap in some ratio that they need, and you get a yield on providing that. Now, the risk here is you need to secure this. It's your own wallet. There may be some protocol risk, some bugs in the code, some hacks that happen. There's also this kind of concept of impermanent loss. So impermanent loss is basically when the price of the tokens that you provided changes such that the ratio that the market needs changes, and that leads to some kind of loss. So for example, we go for an example here. Now imagine that over time, the price of token A increases significantly more than price of token B. If Alex decides to withdraw their tokens from the pool, at this point, they'll receive fewer token A and more token B than they initially contributed. So you're losing tokens A because they increased in price. So when you take it out, you're receiving less than what you actually put in. So you actually lost. Even though you have the same value, dollar value, you actually have less of that token. The difference in value between what Alex originally put in and what they could potentially receive back is called impermanent loss. The loss is considered impermanent because as long as Alex keeps their tokens in the pool, they won't experience an actual loss. The risk of an actual loss can be offset if Alex waits until the price ratio returns to the initial exchange rate. So with yield farming, there's all sorts of crazy things you can do. I've seen yields of more than 20%. You can deposit liquidity and then receive a liquidity provider token, take that liquidity provider token, put it into another decentralized app, and then out pops a stable coin. Then you can take that stable coin and then put it into another platform and then trade that. There's so many different things you can do with it, and you need the time to check what's going on with this, because you could end up losing your money if you take it out. You need the time to spend on this. And now moving on to the final destination here, which is trading on centralized exchanges like Binance or Coinbase. CeFi here means centralized finance, which is basically just normal finance. And this has the highest potential returns, but also the highest risk of total capital loss, which I will explain in a minute. So an example is obviously Binance, trading on Binance. Now I say it's the highest risk of capital loss because you can trade on leverage, which is basically trading with someone else's money. And if you lose, you lose big. But if you win, you win big. So you could, with this, you could lose more money than you actually have. You could owe money. So that's why I say it's the highest risk of total capital loss. But on Binance, the other risk is that you also have to trust Binance is keeping your funds safe, and the risk of just trading like any other trading platform. You have to know what you're doing of trading. You need to spend time on it. It's a full-time job, like I keep saying. But if you get it right, the returns are great. This may not be a good example, but I always remember the story of Sam Bankman-Fried. Before he was the FTX CEO, before all that, he was just a trader, and he was making something like $2 million a day or something like that trading. I think he was doing some arbitrage trading on the price of Bitcoin between the price in Korea versus the price in the US or something like that. Okay, so hopefully that breaks it down for you, and you're more aware of the risk and reward ratios for each of these. I will now go through what I did on this decision tree. So I started out with, let's say, about $7,000 that I could risk. I had saved that money up just from working after uni, just putting away money. And I saw an opportunity in blockchain because the market was going up, and I came across a project that I really believed in, that I thought it really solved the problem. And so I invested in it. Now, at the time, I was working a full-time job, but I was so in love with the market, or I had so much interest for it. It was just so interesting for me. I kind of fell down the rabbit hole, as they usually say. And I wanted to commit a lot of time to it. So I spent a lot of time after work researching, let's say about 2 hours a day after work researching stuff. So I did active investing, and I did HODLing. So I researched individual coins, and based off of my own research, I invested in them. And I also did some staking with Ethereum. The staking I did with Ethereum is liquid staking. So I don't have 32 Ethereum. But with liquid staking, you're able to stake Ethereum without having 32 Ethereum. And the outcome of that is now I have moved up into this decent category here, which I'm happy about, of course. And I still have a lot of time, but I am patient. So I'm a patient person. I like fundamental analysis. I like researching stuff. It's interesting for me. So now I'm still hodling, sorry. I'm still staking, but I'm now looking at small cap equity in blockchain. Not looking at NFTs. I don't have the time to look at that as well. I'm not looking at nodes. I'm not looking at yield farming. I'm not looking at ICOs. I'm not looking at becoming an angel investor. Okay, so hopefully that was useful for you guys. I will go through a recap right now on how to use this. So you like the look of blockchain, but you not really know where you should start in terms of investing your money. First thing you have to ask yourself is, how much money can you risk? Let's say it's around $100,000, which is a decent amount of money. Great. Next thing you want to ask yourself is, how much time can you commit? If you have a lot of time, let's say you have 2 to 3 hours every day to look at this, Next thing you want to ask yourself is, are you patient or impatient? Now let's probably say you're impatient, you need the money. Then I would suggest you look at swing trading. And the things you have to look at with swing trading is looking at trading on decentralized exchanges and centralized exchanges. You have to look at technical analysis, and probably you want a bit of fundamental analysis as well. Moving on to the right here, this goes through the list of the different options in order of increasing risk of total capital loss, which is losing all your money. We start with interest on stablecoins, which is the least risk of total capital loss. It goes down through equity, HODLing, staking, nodes, VC, NFTs, ICOs, trading, yield farming, trading on CeFi with leverage, which is the highest risk of total capital loss. The green shade here signifies how much returns you can possibly gain. So light green is low possible returns, but maybe it's stable. Dark green is very high returns. Okay, so that's it, guys. Hopefully that was useful. Give me some feedback in the comments below, and I'll see you next time. Thank you very much.